inspiring interviews with today's top landlords. This is the Rental Income Podcast. And now, Dan Lane.
If you don't have money to buy a rental property, or maybe you have some money but you'd rather not put it into a deal, the BRRRR Strategy is a great way to buy rental properties and also a great way to build some long-term wealth. If you're not familiar with how it works, basically what you're going to do is you're going to buy a beat-up, run-down house. You're going to buy that house using a short-term loan. You're going to get financing to buy the house and also to fix it up. So you're not going to need any of your own money. You're going to borrow the whole thing. You're going to fix the property up. You're going to rent it out, and then you're going to refinance into a long-term loan. And the magic to the BRRRR Strategy is that when you refinance, you don't need a down payment because you've created that down payment by fixing the property up. You've added a lot of value and you have increased the value of that house, and that magical equity is now your down payment. So it's a really awesome way to build your rental portfolio. And my guest today has done this, and he's done it over and over and over again. So on the show today, we're going to find out exactly what to do, exactly how he's done it. We'll talk about any roadblocks he's run into along the way and get into the financing a little bit deeper. So let's take a really quick break. We'll thank our sponsors. We'll come right back and we'll meet Darren Hoefgen from St. Louis. Having to evict a tenant is painful. The best way to protect yourself from evictions is to screen tenants, and the best way that I know of to screen tenants is TransUnion SmartMove. It's a really valuable online screening tool delivering credit, eviction, and background reports in minutes. And their proprietary tenant credit check predicts evictions 15% better than generic credit scores. See why over 4 million landlords have used SmartMove to make better leasing decisions. Use code RENTAL25 at checkout to save 25% at tenantscreening.com. That's code RENTAL25 at tenantscreening.com. The first step in buying a rental property is to get pre-qualified, and I would suggest you work with a lender that specializes in working with investors, because the last thing you want to have happen is to get to closing and find out the money's not there and you can't close. The lender that I recommend is Chaley Ridge from Ridge Lending Group. She's a nationwide lender, and she'll pre-qualify you for free if you mention Rental Income Podcast. Find out more today. Contact Chaley at ridgelendinggroup.com. That's RIDGE lendinggroup.com. NMLS 42056. Hey, Darren. So when you were first starting out in real estate, you were flipping houses, but you pretty quickly realized that that wasn't the right path for you. What was your thinking, or what happened?
Yeah, I mean, it was absolutely in that. What happened was I realized it is a whole crap ton of work for only one check. Mm-hmm. I got so sick of being beaten up on inspections and flipping these houses, and the buyers thinking that these are new construction, everything's perfect. So sick of getting beat up on those inspections that I really kind of dreaded the whole selling part of the flipping houses. Growing up, my parents had built some rental property, so I was always kind of conditioned that that's what investing was. And I learned about flipping houses through other means. But I always was knowing that I wanted to create that passive income and not have to hustle if I didn't want to hustle, and still get paid every month. Let the mailbox money show up.
So for building out your rental portfolio, you've used the BRRRR Strategy. And was that just kind of a natural next step for you with your rehab background? Is that why you did the BRRRR Strategy, or was there something else that drew you to that strategy?
I didn't even know what it was when we started doing it.
Okay.
So it wasn't like I sat down and said, all right, here's our path to the passive income. Again, we had this conversation with the banker, and I was we had just finished up a house that was in a great area. And great mix of rental and owner occupied. And I really prefer to own in those areas. I love to own houses. It'd be the only rental on the block. Mm-hmm. And that's what this one was. And I kind of decided, you know what? We're going to list it. We're going to not be negotiable at all. And if we get top dollar for this house, great. We'll celebrate it and move on. Because that was going to be, like a $20,000 check, on a starter home in St. Louis here. It's, a pretty decent rehab. It's kind of the bread and butter rehab. So if I got my 20 grand, I was going to take it and run. But in about 2 weeks time, we hadn't accepted an offer. So I thought, you know what, let's go see if this banker buddy of mine will actually, do it, or if he was just, blowing smoke. And sure enough, he financed that place out. We still own it today. It's probably been 5 years or so. And that actually, it's the same tenant is still in place too.
Awesome. All right. So then as you were going to buy more properties after that, did you just kind of think, 'cause you said you had never heard of the BRRRR strategy, was your natural way to think that this works is you buy a property, you fix it up, and you rent it out, and then you refi?
It worked once.
Yeah.
Surely we can make it work again. And we kept doing that slowly shifting from flipping houses to holding them.
Okay.
And after, probably 6 months to a year, we kind of kicked the whole flipping to the curb because, again, that's a whole lot of work for one check. And I'd rather have somebody else pay off my mortgages for me.
Sure. All right. So let's kind of walk through the whole BRRRR strategy from the beginning to kind of see how you're doing it. So the first step is getting the short-term financing. So you've got the long-term financing set up with your banker buddy, but getting the short-term financing to buy the property initially, how did you line up that financing?
Well, I like to approach the whole thing backwards.
Okay.
So kind of like if it's a math problem, work it in reverse. So the first thing, to your point, the first thing to solve for is that long-term money. But every bank had their own rules. So I spent a lot of time, shaking hands and kissing babies and going to a lot of these bankers and learning what their business model was, what their appetite for residential real estate was, and what their rules were. And some of them had certain debt coverage ratios. Some of them had, loan to value ratios. Some of them had seasoning rules. So I went and collected all this stuff of a bunch of the local players and all the referrals I could get. And the reason I did that was I wanted to make sure when I was done with the project, I could actually get it financed, refied back out.
That's smart. Yeah. I think that's really smart to have an end game in town, and hopefully people are doing that. If not, that's definitely the first thing everybody should do.
Oh yeah.
Okay, so you've got an out, but to get into the property, how were you getting that short-term financing to initially buy the property and fix it up?
Yeah, so that's all about private money. Everything we've done in the BRRRR process in the rental business has been private money. We've been fortunate that between training I've had and the relationships that I've built over the years, that I've been able to raise quite a bit of private investors who will lend us money secured in real estate and let us buy it and rehab it, and then we just refinance them back out to replace their money with the bank money.
And how are you finding the private investors? Are these people that you knew or family members, or how did you find your private investors?
Yeah, so private money is really, I think of it as relationship money. Mm-hmm. So people are going to lend me money because they know me and they trust me. Mm-hmm. And it is a little bit of a snowball effect. Most of our first private lenders were personal relationships of mine or my business partner. Okay. Now that we are, almost a decade or so into this process, and we have a lot of success behind us, and we have, institutional money, bank money backing up what we're doing. It kind of is another, you guys are on the right path thing. Now it is much less about the relationship and more about the confidence people have in when I meet them and talk to them about stuff. I'll get referrals from, existing lenders. I'll have conversations with somebody. I mean, I've had a conversation with somebody at a RIA meeting, and once he realized that, we are a serious player and we know what we're doing, he opened up and had, a bunch of money that he was happy to lend.
Awesome.
So it really now, we're fortunate that we've had some success behind us. We had a track record. We have a track record. It's turned into I want to say easy. I don't want to jinx it, but it's not nearly as scary as it was when we started. When we started, it was a lot of talking to friends and family and, talking to people about their retirement plans and self-directing and all these other things that you may have heard about or that anybody, has kind of read or, seen people talk about at REIA. We've gone down those paths and learned and tried to connect with as many of those dots as possible. It's really early on for us. It was a matter of throwing things on the wall and seeing what stick.
That makes a lot of sense.
Most of what stick was the family stuff.
Yeah, that makes a lot of sense because it's like the more you do it, the more success you have, the more things kind of snowball. And I think that really applies to anything in life, but specifically with doing the BRRRR strategy and raising money, I think that makes a lot of sense. What kind of terms do you offer your investors?
For our private lenders, we typically are paying 12% for our money.
Okay.
No points, and we accrue it all at the end.
Okay. And how long does it generally take you from the time you buy the property until you refi out to your long-term financing?
It's a great question, and it's not an easy one. There's really two answers to that. In the perfect world, that answer is driven by how long does it take us to rehab the house and get the tenant placed, and then the bank is lined up and ready to go. Mm-hmm. And sometimes that works, and we typically are turning our properties in 6 to 8 weeks. In most cases. So in the perfect world, I could have you as my investor. I could have you out of that house, out of that loan in 3 to 4 months.
Okay.
So that's the happy path. That's when everything works perfect. The reality is, because of the size of the loan, so the average house value in our portfolio here in St. Louis is probably about $90,000, which means some of the loans we're looking for are $50,000, $60,000, $70,000. These aren't things that these banks are super excited to spend a whole bunch of time writing one loan on.
Right.
Most of my banking partners, they really want us to package up and do a handful of these at a time.
Okay.
They'd much rather write $500,000 worth of lending. It's easier for me to borrow $500,000 than it is for me to borrow 50.
Right.
So that time, I always, to answer your question about timeline, I always share that with all of my prospective lenders. Here's what this process looks like. It doesn't really matter in that you're earning your interest for as long as it takes. My job is to get the bank moving. Sometimes the bank moves, sometimes it doesn't. I usually will say guidance, target 6-ish months.
Okay. Well, I mean, your lenders probably like it when it takes you longer because they're getting that interest for a longer period of time. Is that right? Or do they start freaking out if it takes too long?
Yeah. I even have a, I call it a gentleman's agreement, with all of my lenders. I say, listen, if something happens and you need the money back because of something, life throws you a curveball, let me know. Give me as much warning as you can, and I will do my best to slide another lender in and get you paid out. And we've done that a handful of times.
So how do the numbers work? Like if you have to hold on to the property for a while and you're paying 12% interest, are you still making money at the higher interest rate, or are you going to be at a loss for a few months?
That's going to depend. And it really depends on how I buy it. And I guess if you're looking at it from, am I generating cash flow on a month-to-month basis based on my expenses that month? Typically, no. At 12% interest, the property doesn't cash flow.
Okay.
But if I buy it right, I build that all in. So I buy it with the intent that I'm going to hold this thing for 6 months, where I may be getting rent payments out of the place, but have no outbound payment going to it.
Okay.
And all that, because all that interest is accruing. And then at the end, whenever the bank comes in, that's when I gotta, pay the piper. Now I gotta balance everything out.
Right.
And sometimes I have to write a check. Sometimes I get a check.
Okay.
It just depends.
Okay. So now that we got the financing all squared away, let's talk about how you find potential rental properties. Mm-hmm. So, what are you looking for in a property?
It really depends. My favorite properties are kind of solid blue collar neighborhoods. They're, B and C neighborhoods. I really like the things where when you're driving down the street, there's a lot of pride of ownership. People are landscaping. The cars are in decent shape. Those are my types of deals. Where do I find my deals? I buy from wholesalers. I buy from my network.
Okay. All right. So now that, say, a wholesaler has brought you a deal, the numbers all work. Now you've got to figure out what you're going to do to the house. And I'm sure there's a danger in over improving the house. Like, so how do you balance making something good as a rental, but not too good and not spending money that maybe you don't need to spend on a rehab?
Well, it's a double-edged sword. People rent for the same reason that they buy. Mm-hmm. They're just more transient when they're renters. So that means if I have an opportunity to make a kick-butt kitchen, kick-butt bathroom, I'm going to do that.
Mm-hmm. Okay. So
how do I make those decisions? Go ahead.
So are you going to fix it up for the kitchen and the baths? Would you fix them up to the same quality or the same standard that you would do to a flip back when you were flipping houses?
To the same quality or standard of the neighborhood. Yes.
Okay. Solid. Okay. So you've got good kitchens, good bathrooms. Do you find that those are the two most important things that tenants are looking for?
Yeah. Interesting in that, and this was a shift that I made in when you're renting the house, you don't care about the roof because if the roof leaks, it's not your problem.
Right.
You don't care about the HVAC because if it doesn't work, it's not your problem. So I typically don't spend money on those things unless they are going to fail in the near future.
Okay. Yeah, that's always something I struggle with. When I buy a property, if there's an older HVAC system, sometimes I think, well, maybe I should just replace this now because it's going to be less hassle. I'm not going to have to deal with the tenant not having heat or something. But, if you can get another year or two out of it, why not get another year or two out of it and put that expense off? So you've decided just to put that off for as long as possible?
Yeah, I mean, with those things, the big system costs. First off, as an investor, as a real estate investor, as a rehabber, whether you're holding or you're flipping, we all hate spending money for things behind the walls because nobody's going to pay for that.
Right.
So anything that is behind the walls, whether it's electrical, plumbing, HVAC, or even a roof, anything along those lines, if I think it's going to last 5 years without having to be full replaced, then I'm going to let it go.
Okay. Yep.
And the 5 year, this is, kind of Darren's rule. The 5 year rule is because most of my lending have 5 year balloons. So I know if my roof is going to last me 5 years and my loan is going to last me 5 years, in 5 years time, we will have paid down the debt. We're going to have to go to the bank and refinance anyway. So if I need to, if I don't have the cash available, I can pull a little bit of equity out and do the roof.
Yep. All right. And now let's talk about, as you're finishing up the rehab, do you start marketing the property before the rehab is done, or do you wait until everything's done, the house looks perfect, and then market it?
I used to do it like super early, and I'm like, as soon as I can get a warm body in here, let's do it. And what I've learned is two things. One, we don't do that anymore. I wait until it's good to go, and it's basically move-in ready.
Okay.
And that's for two reasons. Number one, in my experience, people don't plan very far in advance for moving for a rental. Mm-hmm. It's not like a home move where it's a 45-day close and they've been working on their financing for a while, all this stuff. People typically will give their notice and then start to go find a new house. Right. So they have a 2 to 3 week window to make this happen.
Right.
The other thing is that people have no imagination.
Yeah.
If they walk through the place and there is construction mess there, if there is drywall dust all over the place, they automatically think that the house is dirty and gross and I don't want to live here.
Yeah.
So we stopped doing that. We may put a sign out front and collect information, but I'm not going to let anybody go into it until it's been cleaned.
Right. Okay. That makes a lot of sense too. Now, the last step of the BRRRR is the repeat. And this is something that you have just done over and over and over again. How many BRRRRs have you completed?
I think including what's in process right now, I'm at about 80.
That's incredible. That is absolutely incredible. Has it always worked out, or have you ever gotten stuck where the numbers were just totally wrong and you couldn't refi and get out all the money?
Oh yeah. I mean, there's been times where I couldn't refi and get the money out. I'm fortunate in that those have happened more recently, and that the portfolio is big enough now and producing enough income that if I have to write a check, it's not like it's property number 3 and I had to figure out where that money's going to come from.
Yep.
You know, we've had, just like you will on a flip rehab, we've had rehabs go sideways where, you know, we initially bought it with a budget of, I don't know, 15 and it ended up being 40 when, you know, everything that could have gone wrong did go wrong. Yeah. From the rental perspective, the rental business, it kind of sucks until you get to about a dozen doors.
Mm-hmm. Yeah.
Because if you're under a dozen doors, every time the phone rings, assuming you're leverage, you know, every time the phone rings, you're like, oh crap. Yeah, because if that's your property management calling and you have to put on a roof or HVAC, there goes your entire year.
Right.
Once you get over that critical mass, which is typically in this market, in my Midwest markets, it's typically about a dozen doors. Once you get over that, those phone calls are like, well, that sucks, but it's not the end of the world.
Right. Right. Yeah. You know, it's so true that, and we were talking about this last week on the podcast, that rentals get a lot easier the more you have. You know, it's like if you have 2 properties and you have 1 vacancy, you know, that's really you feel 50%. That. Yeah, right. But, you know, as you get more and more, everything just matters less. You know, putting on a new roof is no big deal. Having if you have a vacancy on a property, I mean, that at this level, like, you probably don't even really notice that, right?
Yeah, I mean, right now, I notice it when my vacancies go up or when they sit longer.
Mm-hmm.
That's when I notice. Okay. Not that it's vacant, but that when it lasts longer, and then it's like, all right, what's going on?
Yeah. If Darren inspired you and you're ready to buy a rental property, whether it's your first property or you want to add to your portfolio, the very first thing you need to do is get a lender on your side to figure out the financing. And the lender that I recommend is Chaley Ridge from Ridge Lending Group. She's a nationwide lender, and she specializes in helping investors buy rental properties. She's got a ton of different loan programs. So whatever your situation is, she can help you. If you don't have the best credit, she's got a program for that. If you've got a smaller down payment, she can work with you. If you've got at least 15% to put down, basically whatever your situation is, Chaley can help you buy a rental property. If you want to find out more, go to ridgelendinggroup.com. That's RIDGE lendinggroup.com. If you mention Rental Income Podcast, she will waive all of the pre-qualification fees. NMLS 42056. Thank you so much for listening and subscribing to the podcast. We'll be back with a new episode next Tuesday. My name is Dan Lane, and this has been the Rental Income Podcast.